Every trader loves a good risk to reward situation. A trade where they could bet one to potentially make 5, 10, 15 times their money. Especially if you're trading a smaller amount of capital, it's high risk to reward trades like this that could give you the leverage you need to grow that account quickly. Now, of course, risk to reward isn't the only thing that we want to look at. We also want to consider our risk exposures and the probabilities of us actually hitting the trade. But when we have that high risk to reward, it decreases the frequency with which we actually have to be correct in order for us to have a winning strategy. In this video, I'm going to share with you the trade structure that I use to get high risk to reward trades and the factors I look for in the market to determine which stocks I'm actually going to be placing this trade on. So if you find the information in this video helpful, make sure to hit the subscribe button and leave a like on this video. It lets me know that you're finding this content valuable and really pushes me to make more videos like this for you. So let's get into it. So the trade structure that I'm going to be sharing with you today is called a 1-3-2 butterfly. And a 1-3-2 butterfly allows us to take advantage of overpriced out of the money options to structure a cheap, high risk to reward directional bet. So the first thing I'm going to do is share with you the actual factors that I look at for putting on this trade, and then I'm going to hop into my brokerage and show you exactly how I put it together. The first thing I do is I come to my Volatility Insights tab in the Predicting Alpha terminal, and I use this scanner at the top to filter through all the opportunities that are out there to find the best ones to put a 1-3-2 fly on. The two factors that I look for when I'm putting on a 1-3-2 fly are expensive volatility and skew, meaning that the out of the money calls or puts for a stock are more expensive than the at the money options. Now, what I'm going to do is show you how I filter for those factors using my Predicting Alpha terminal. The first thing I do is come to the Volatility Insights tab, and I'm going to use this scanner at the top to filter through all the opportunities that are out there to find the ones best suited for this type of trade. So to get started, I put in a price filter above $15 and an average option volume filter above 3,000. What these do is ensure that I'm trading a stock that has enough liquidity for me to be able to get in and out of the position with ease. Next up, I apply a filter for IV versus forecast, which takes the market implied volatility 30-day and divides it by my forecast of what volatility will be for the next 30 days. When I find one that has a higher implied vol than my forecast, it means that the market thinks the stock will move more than what I think it will for the given time period, aka options are expensive. The final thing I do is, now that I've filtered through opportunities, reduce the total pool of stocks that I'm looking at from 879 down to 55, I'm now going to rank them all for ones that have the lowest skew. The reason I chose to filter for the lowest skew is that means it'll be the ones where the out of the money calls are more expensive than the out of the money puts, aka call skew. Meaning that I'm looking for a stock where I can make a bet on it increasing in value and get that risk to reward that I'm looking for. After applying these filters and sorting everything by skew, I came across Sony, which is the stock that I'm looking at putting on a 1-3-2 fly for. So let's break it down a little bit further. So I'm going to type in Sony's ticker at the top here, and it's going to populate the data for me. What I can see off the bat is that the implied volatility 30-day is significantly higher than what I'm forecasting volatility to be for the same period, meaning that I think the options are expensive. Now, the second factor I look for is skew. So if I scroll down and look at the skew analysis, let's just look at, let's say, the 10-day options, I can see that there is huge call skew. Right? This is a graph that basically plots the out of the money puts, the out of the money calls, and the at the money options. I can see that the at the money options are implying about 24% volatility, whereas the out of the money calls are implying almost 28% volatility. And this is something that I can take advantage of. So off the bat, I can see that Sony has expensive options and call skew. So I can now go ahead over to my terminal and structure out a 1-3-2 fly, and you're going to see the risk reward that I get on this trade. So here I am on the option chain for Sony, and since I want to be trading the near dated options, let's take a look at the December 18th expiry. Today is December 14th, by the way. And the first thing I'm going to do is price out what the straddle is going for. This is going to be an important step in structuring our 1-3-2 fly. So let's do that right now. The stock's going for almost $94, so let's price out the 94 straddle. Sell, straddle. And we can see that it's going for about $2. So now that I have that in the back of my mind, we're going to go ahead and structure out our 132 call fly. So I'm going to go to $94, come across to the call side, buy unbalanced butterfly. And off the bat, it'll populate the actual structure that I want. 1, 3, and 2, right? We're buying 1 at the money. We're going to sell 3 out of the money, and we're going to buy 2 even further out of the money as a hedge for our position. Now it populated 10 lots, so we'll roll with that for now. And now let's go ahead and change our strikes to be what we actually want. So our at the money strike, we want to put that to 94. And now this is where we're going to use the straddle price. We are going to be selling the 3 out of the money options 1 straddle price higher than the at the money strike. So I'm going to change this to 96. And for the 2 that I'm hedging, I'm going to place it half a straddle price even higher than what we sold the out of the money options at. So I'm going to change this to 95. So to recap, we bought 1 at the money, sold 3, 1 straddle price higher than at the money, and then bought 2 more, 1.5 straddle prices higher than at the money, or a half straddle price higher than where we were selling the 3 options. So let's take a look at what we have here now. So as we can see, we are risking about $270 to potentially make $1,700. So we're getting about 1 to 7 risk to reward on this trade. Now, in order for us to be profitable on this trade, what needs to happen is that Sony rallies from $94 to, in an ideal world, $96, but anywhere between $94.30 and about $96.85 is really the profit zone, where if it lands in this range, we are going to be making money on our position. What's really cool about this too is that it only costs us a little bit to put on a trade like this, 28 cents per lot. So if you have a small account, this is a trade you can put on that has a high risk to reward and doesn't require you to outlay a ton of capital off the bat. So to recap, I'm looking for stocks that have expensive options and either call or put skew. If it has call skew, I'll be able to structure a trade to the upside that has a really good risk to reward. And if there's put skew, I'll be able to structure a trade to the downside that has good risk to reward. Now, opportunities like this can be found every single day in the market, but you need to be able to scan for them. And this is why people love their Predicting Alpha terminal. It allows them to make sense of information that the average trader is simply unable to access. Looking at skew, forecasting future volatility, these are the reasons why somebody would purchase a Bloomberg terminal. That's why data costs $25,000 a year. But now it can all be yours. Thousands of dollars in data, hundreds of hours of education for $79 a month. If you want to learn more about Predicting Alpha's terminal, visit predictingalpha.com or shoot me a message. I'm always here to talk about it. Thanks a lot for watching the video. And if you found this video, please hit the subscribe button. We'll see you in the next one.